Personal loans are one of the fastest growing forms of consumer credit in the US, used by millions of people to cover a wide range of expenses. In fact, as of 2025, roughly 22 to 25 million Americans have at least one personal loan, with an average balance around $11,600. But what exactly is a personal loan, and how does it differ from other ways of borrowing money? In this beginner's guide, we'll break down everything you need to know in clear, simple terms. In the next 30 minutes, you'll learn what a personal loan is and how it works, how it compares to credit cards and auto loans, the common uses of personal loans, and the key pros and cons. We'll also walk through how to choose the right loan for your needs and share tips for borrowing responsibly. By the end, you should have a solid understanding of personal loans and be equipped to decide if one is right for you. Let's get started. Need extra cash for home upgrades, debt consolidation, or unexpected bills? Get the funds you need fast with today's best personal loan offers: trusted lenders, low fixed rates, and no hidden fees. Compare options in minutes and see how much you could save. Click the link in the description and find your perfect personal loan today. A personal loan is a type of installment loan that allows you to borrow a lump sum of money from a lender, such as a bank, credit union, or online lender, and repay it over time in fixed monthly payments. Unlike credit cards, which offer a revolving line of credit you can tap as needed, a personal loan gives you a one-time cash disbursement that you pay back on a set schedule. The loan comes with an interest rate, and sometimes fees, that you'll pay in addition to repaying the amount borrowed. Personal loans are typically unsecured, meaning you don't have to put up collateral, like a house or car, in most cases. This makes them accessible for a variety of purposes. If approved, you can use a personal loan for almost any expense, from home renovations to medical bills, as long as you commit to repaying it. In summary, a personal loan is an installment credit product. You receive a lump sum upfront and then make regular monthly payments, including interest, until the loan is paid off. The loan term, length of repayment, is fixed, often a few years, and the payments are usually fixed amounts each month, which provides a predictable repayment schedule. You'll need to meet the lender's eligibility requirements, such as credit score and income criteria, to be approved, and loan offers can vary widely based on your creditworthiness. It's helpful to understand how personal loans differ from other common financing options, like credit cards or auto loans. The biggest difference is in how the credit is provided and repaid. Credit cards are a form of revolving credit. You have a credit limit and can borrow as needed up to that limit, carrying a balance month to month. There's no set payoff date for a credit card. You can reuse the credit line as you pay it down. In contrast, a personal loan is a one-time lump sum dispersed to you, which you then repay in installments over a fixed period. Once you take out a personal loan, you can't borrow more on that same loan. If you need more money, you would have to apply for a new loan, unlike a credit card, which you can continue to use up to its limit. Personal loans also tend to offer lower interest rates than credit cards for borrowers with good credit. For example, the average interest rate on a 2-year personal loan from a bank was about 11.7% in early 2025, whereas the average credit card interest rate was around 21.4%. This difference makes personal loans popular for refinancing or consolidating credit card debt. Another difference is that personal loans have fixed monthly payments and a defined end date, making it easier to budget for repayment, while credit card payments can fluctuate and you're only required to pay a minimum amount each month. Credit cards do offer flexibility. You only borrow what you need when you need it, and potential perks like rewards. But if you carry a balance, the high interest can make them an expensive way to borrow. Auto loans, on the other hand, are installment loans like personal loans, but are specifically used to purchase a vehicle. An auto loan is typically secured by the car itself. The vehicle serves as collateral for the loan. Because of this collateral, auto loans usually have lower interest rates than an unsecured personal loan. For example, A personal loan is usually unsecured, no collateral, and might have an APR in the range of 6% to 36%, whereas an auto loan secured by a car might have a lower APR range around 5% to 28% for similar borrowers. Auto loans also often require a down payment and are only used for vehicle purchases, whereas personal loans can be used for almost any purpose. In short, personal loans versus auto loans. Personal loans provide flexibility and don't require collateral in most cases, but auto loans are tailored for car buying and tend to be cheaper because the lender's risk is lower with the car as security. Most personal loans are unsecured, meaning you don't need to pledge any collateral to get the loan. Approval is based on your creditworthiness, credit score, income, and financial history, rather than on an asset. If you have a strong credit profile, you can usually qualify for an unsecured personal loan. However, some lenders do offer secured personal loans. A secured personal loan requires you to provide an asset as collateral. For example, some banks might let you secure a personal loan with a savings account, a car title, or other assets. Because offering collateral reduces the lender's risk, they have something of value they can claim if you fail to repay. A secured personal loan might be easier to get approved or come with a lower interest rate, especially if your credit is less than perfect. Unsecured loans are far more common for personal lending. The trade-off is that without collateral, the interest rates on unsecured loans can be higher than on secured loans, particularly if your credit score isn't high. Lenders compensate for the higher risk with higher rates. Individuals with excellent credit can often get unsecured personal loans at favorable rates, while those with lower credit might either pay a higher rate or be asked to secure the loan. Always be cautious with secured loans. If you pledge collateral, like your car or a bank account, and then cannot repay the loan, the lender can seize that asset to recover their money. In any case, whether secured or unsecured, personal loans oblige you to repay on time. Defaulting will damage your credit, and with a secured loan, you'd also lose the asset you put up. Applying for a personal loan is usually a straightforward process, and it can often be done online, over the phone, or in person at a bank or credit union. When you apply, the lender will ask for information about you, typically your personal details, the amount you want to borrow, and the purpose of the loan in some cases. They will also run a credit check and ask for documentation to verify your income, like pay stubs or bank statements, and identity. Most lenders have minimum requirements you must meet to be approved, such as a minimum credit score and a stable income or employment history. They may also calculate your debt-to-income ratio to ensure you're not taking on more debt than you can handle. Many lenders prefer to see that your monthly debt obligations are below about 36% of your income. The application itself typically involves filling out a form with the loan amount and desired term, and consenting to a credit pull. Many lenders offer a pre-qualification step beforehand, where you can get an estimate of the rate and amount you might qualify for with a soft credit inquiry, which doesn't impact your credit score. This is a great way to shop around and compare offers before formally applying. Once you submit a full application, the lender's underwriting team will review your credit report, income documents, and other factors to make a decision. Approval can be very fast. Some online lenders can approve loans within minutes to a day, while traditional banks might take a few days. In many cases, personal loan approvals and funding happen within 1 to 2 business days if everything is in order. If your loan is approved, the lender will present you with a loan agreement detailing all the terms. This includes the interest rate, the schedule of monthly payments, the length of the loan, term, and any fees charged, such as an origination fee, and when they're due. Be sure to review these documents carefully. Once you sign the agreement, the lender will disperse the loan funds to you. Commonly, the money is delivered via direct deposit to your bank account, and this can happen quite quickly, sometimes the same day or within a couple days of approval, depending on the lender. Note that if the lender charges an origination fee, this may be deducted from the loan amount before you receive the funds. For example, if you borrowed $10,000 and there was a 3% origination fee, you might get $9,700 deposited to your account, while $300 goes to the fee. After disbursement, the loan is officially active and you will begin repayment as scheduled. Your credit score and income are two of the most important factors in qualifying for a personal loan and determining what interest rate you'll pay. Lenders use your credit history as a measure of trustworthiness. A higher score suggests you have a record of responsible credit use and on-time payments. Typically, you will need at least fair credit, around a 580 FICO score, to get a personal loan at all, and a higher score, in the high 600s or 700s, to get the best interest rates. According to Experian, lenders often want to see a minimum score of about 580 for approval, and around 700 plus if you're hoping to snag favorable terms on a personal loan. Keep in mind that these are general guidelines. Every lender has its own criteria. Some online lenders specialize in loans for people with lower credit scores, but those loans usually come with much higher interest rates to offset the risk. Income is the other key piece. Lenders want to be confident that you have enough steady income to afford the loan payments. During the application, you will typically be asked to state your annual or monthly income and may need to provide proof, such as recent pay stubs, W-2 forms, or bank statements if self-employed. The lender will consider your income relative to your existing debts. This is your debt-to-income ratio, DTI. A lower DTI, meaning your monthly debt payments are low compared to your monthly income, indicates that you have capacity to take on new debt. Many lenders prefer a DTI around 36% or less, though some will accept higher, especially if you have compensating factors like a high credit score or cash reserves. If your DTI is very high, it could be a red flag that adding another loan would stretch your budget too thin. Before applying, it's wise to check your credit report and score and take steps to improve your credit if possible, such as paying down existing card balances or correcting any errors on your credit reports. Also, calculate how much of a monthly payment you can comfortably afford based on your income and expenses. Remember that just because you qualify for a certain loan amount doesn't mean you should borrow that much. Only take on a loan you're confident you can repay. Lenders will verify your income and may even call your employer to confirm employment in some cases. Losing your job or having unstable income can derail an application, so expect to show that your income is consistent enough to cover the new loan's payments. How much can you borrow with a personal loan? It varies by lender and by your qualification, but personal loan amounts typically range from as little as around $1,000 up to $50,000 or $100,000 for well-qualified borrowers. Many lenders have minimum loan amounts, often $1,000 or $2,000, and maximum amounts that can go into the 5 figures. The exact amount you'll be approved for depends on your creditworthiness and income. Even if a lender offers loans up to $50,000, you might only qualify for $5,000 or $10,000 if your financial profile is more limited. One advantage of personal loans is flexibility. You can borrow a smaller amount of a few $1,000s if that's all you need, or a larger sum for major expenses as long as you qualify. Personal loans are medium-term loans. The repayment term, the length of time you have to pay the loan back, usually ranges from about 12 months, 1 year, to 60 or 72 months, 5 to 6 years, though some lenders offer shorter or longer terms. A very common loan term is 36 or 60 months. You'll typically get to choose from a few term options when you take the loan. For instance, a lender might approve you for $10,000 and let you pick a 3-year term or a 5-year term. Shorter terms mean higher monthly payments but less interest paid overall, while longer terms give you lower monthly payments but more total interest cost. It's important to find the right balance based on what you can afford each month. Most personal loans have fixed terms, meaning the end date is set in advance, unlike credit cards, which you could carry indefinitely if you only make minimum payments. Interest rates on personal loans can vary widely. Annual percentage rates, APR, typically range roughly from about 6% on the low end to 36% on the high end for unsecured personal loans. If you have excellent credit, you might get a rate in the single digits or low teens. With fair or poor credit, you could see offers in the 20% to 30% plus range. The rate also depends on market conditions and the lender's policies. Personal loan rates are generally fixed, not variable, which means once you take the loan, your rate and payment don't change over the life of the loan. This fixed rate provides certainty in budgeting. According to recent data, the average APR on a 3-year personal loan was around 23.5% in mid-2025, but keep in mind that's across all credit tiers. Borrowers with good credit often secure rates in the low double digits, and those with bad credit may hit the upper end of the range. When comparing interest rates, also pay attention to whether there are any fees. The APR of a loan includes both the interest rate and certain fees like origination fees. Some personal loans come with an origination fee, an upfront fee for processing the loan, typically ranging from 1% to 8% of the loan amount. Not all lenders charge origination fees. Many banks and credit unions don't, while some online lenders do. Other potential costs include late payment fees or prepayment penalties. Though prepayment fees are not very common on personal loans nowadays, most allow you to pay off early without extra charge. Always look at the APR as the best measure of the loan's cost, since it reflects interest plus fees over the year. Repaying a personal loan is straightforward. You will make fixed monthly payments for the length of the term until the loan is fully paid off. The payment amount is determined when you take the loan, based on the loan amount, interest rate, and term. Each monthly payment goes toward both principal and interest. In the beginning, a larger portion of your payment is applied to interest, the cost of borrowing, and as the loan balance decreases over time, more of your payment goes toward principal. This is a standard amortization schedule for installment loans. The key benefit here is predictability. You know exactly how much you need to pay each month and when your last payment will be, which makes budgeting simpler. For example, if you borrow $10,000 at a 10% APR on a 3-year term, your monthly payment will be around $323. Over 36 months, you'd pay a total of about $11,628, which includes $1,628 in interest. Each month's payment is the same amount, although the mix of interest versus principal in that payment changes gradually. Early on, you might be paying mostly interest, but by the end, you're paying almost all principal. If the loan has a fixed interest rate, which most do, your payment will not change month to month. Payments are due on a set date each month, for instance, the 15th of every month. It's crucial to make your payments on time. Most lenders offer automatic payment options, auto-pay, which can deduct the amount from your bank account each month. Using auto-pay can ensure you never miss a due date, and some lenders even give a small rate discount, like 0.25% off the APR, for setting up automatic payments. If you ever want to pay off a personal loan early, you can generally do so by paying a lump sum of the remaining balance. Check that there's no prepayment penalty. Paying extra toward your principal can help you finish the loan sooner and save on interest. Conversely, if you miss a payment or pay late, you'll likely incur a late fee and potentially damage your credit. Most lenders report personal loan payment history to the credit bureaus, so late payments, usually more than 30 days late, can hurt your credit score. The bottom line, when you take a personal loan, commit to a repayment plan and include that fixed payment in your monthly budget until it's paid in full. One reason personal loans are so popular is their versatility. You can use the funds for just about any purpose. There are a few common scenarios where taking out a personal loan makes sense. In a 2023 national survey of personal loan borrowers, the most frequent reasons cited were debt consolidation, combining other debts into one loan, home improvements, and other large purchases or expenses. Let's go through some of the top uses for personal loans and why someone might choose a loan in each case. Using a personal loan for debt consolidation means taking out a new loan to pay off other existing debts, often credit card balances. This is consistently the number one reason people take personal loans. The idea is to combine multiple high-interest debts into a single loan with a hopefully lower interest rate and a fixed repayment schedule. For example, if you have several credit cards carrying balances at 20% to 25% APR, you might get a personal loan at, say, 10% to 15% APR and use it to pay off the cards. Then you'll make one monthly payment on the loan going forward, ideally saving money on interest and getting out of debt faster. Debt consolidation loans can simplify your finances by turning multiple payments into one and often lowering the total monthly payment burden. Borrowers also appreciate having a clear payoff timeline, as credit card debt can otherwise linger if you only make minimum payments. It's important that when you consolidate, you also address the habits that led to the debt. Otherwise, you risk running up new balances on those now paid off credit cards. But used wisely, a personal loan can be a smart tool to refinance expensive debt. Many personal loan providers even market debt consolidation loans specifically. If you do consolidate, compare the loan's interest rate to the weighted average of your current debts and factor in any loan origination fees. When done right, consolidating through a personal loan can reduce your interest costs and help you become debt-free sooner. Indeed, personal loans are often viewed as a way to manage or replace credit card debt with a more structured repayment plan. Just be cautious not to accumulate new debt once the cards are paid off. Life is unpredictable, and sometimes you get hit with a major emergency expense that you weren't financially prepared for. This could be an urgent medical procedure, a surprise car or home repair, or any other necessary expense that exceeds your savings. Ideally, everyone would have an emergency fund for these situations, but the reality is many people don't have enough cash on hand. A personal loan can be a lifeline in such emergencies. Personal loans often have a fast funding process. Some lenders can deliver funds as soon as the same day or within a few days, making them useful when you need money quickly but don't have a credit card or savings to tap. For example, imagine your furnace breaks in the winter or you have a family medical emergency. A personal loan could provide the necessary funds to cover the unexpected expense so you can take care of the issue right away, then allow you to pay that cost back over time in manageable installments. This is generally a much better option than something like a payday loan, which we'll discuss avoiding later, because personal loans have far lower interest rates and more reasonable terms. Emergency loans, a term some lenders use, are essentially personal loans, marketed for urgent needs. When using a loan for emergencies, borrow only what you need, and try to choose the shortest repayment term you can afford, so that you pay less interest overall. Keep in mind, if you have time to plan, you might also compare other options, like borrowing from family, or if it's medical, maybe a hospital payment plan. But in a true emergency, a personal loan can provide quick relief and peace of mind. Another very common use of personal loans is to finance home improvements or other major purchases. If you're planning a renovation, say a kitchen remodel, or adding a new roof, you might not have tens of thousands in cash to pay for it upfront. A personal loan can enable you to get the work done now and pay it off over a set number of years. Unlike a home equity loan or line of credit, a personal loan for home improvement doesn't require you to have equity in your home or use the home as collateral. It's unsecured, which is advantageous for those who either don't want to put a lien on their house or who don't have equity. Lenders commonly offer high loan limits, some up to $50,000 or even $100,000, for well-qualified borrowers, which can cover large remodeling projects. By spreading the cost over, say, 5 years, a personal loan allows you to enjoy the upgraded home while making a predictable payment each month. Similarly, people use personal loans for major life events or purchases that are one-time costs. This includes things like weddings, vacations, or buying expensive items. Weddings, for instance, can cost many thousands of dollars. A personal loan can be used to fund the venue, catering, etc., especially if you're trying to avoid putting those charges on high-interest credit cards. Travel is another example. Some folks take out a loan for a dream vacation or a destination honeymoon. While financing a discretionary expense, like a vacation, isn't always the wisest financial move, it is something people do when they have a special reason. The advantage of a personal loan here is you know exactly how long you'll be paying it off, and the rate is usually lower than a credit card's. Personal loans have few restrictions on use, so whether it's a wedding or a big trip, you're generally allowed to use the money as you see fit. Just be careful. For non-essential expenses, make sure the monthly payments won't strain your budget in the long run. Medical expenses are a significant burden for many individuals and families. When faced with a hefty medical or dental bill that isn't fully covered by insurance, a personal loan can be one way to manage the cost. For example, if you get a $10,000 medical bill after insurance for a surgery, you might negotiate a payment plan with the provider, or you could take a personal loan to pay the bill immediately, then repay the loan over a few years. One benefit here is that personal loan rates are usually much lower than medical credit cards or unpaid hospital financing, especially if you have decent credit. In fact, medical expenses are often listed among the primary uses for personal loans, after debt consolidation and home improvements. Using a loan for medical costs might make sense if it allows you to avoid dipping into retirement savings or other costly forms of credit. Some people also take personal loans to finance elective procedures that insurance doesn't cover, like fertility treatments or cosmetic surgeries. Lenders don't restrict such uses. As long as you qualify for the loan, you can apply it to medical needs. If you're considering this route, first check if the medical provider offers any interest-free payment plan, or if a specialized medical loan or credit line with promotional 0% interest is available. If not, a personal loan can provide the cash you need. Just ensure the monthly payment fits alongside your other medical and living expenses. Facing an unexpected medical bill is a scenario where a personal loan might be a preferable alternative to letting the bill go to collections or charging it to a very high-interest credit card. Beyond the categories above, people use personal loans for just about any significant expense. Some additional examples include starting or funding a small business, though business loans might be better suited. A new entrepreneur might use a personal loan for initial capital, buying a used car or boat from a private seller when an auto loan isn't available or practical, paying for moving expenses or relocation, covering education or training costs. Note, student loans are usually preferable for college tuition due to lower rates and protections, but personal loans sometimes fill gaps for educational expenses. Essentially, if you need a lump sum of money and have a plan to repay it, a personal loan is a flexible option to consider. Just always weigh whether taking on debt is necessary or if saving up, using savings, or finding a lower-cost form of credit would be better. The general rule is to use personal loans for one-time, purposeful expenditures that will improve your financial position or quality of life, like consolidating debt, making home repairs, etc., and avoid using loans to fuel ongoing overspending. Like any financial product, personal loans come with advantages and disadvantages. It's important to understand both sides to decide if a personal loan is the right choice for you. Let's break down the key pros and cons. Flexible use of funds. Personal loans can be used for almost any purpose, giving you freedom to finance what you need: debt consolidation, home projects, medical bills, etc. Unlike a mortgage or auto loan that must be used for a specific item, a personal loan's proceeds can be put toward your priority, whether that's an emergency expense or a major purchase. Lump sum with predictable payments. You receive the money in one lump sum and then repay with fixed monthly payments. This installment structure means you have a clear payoff timeline and a consistent payment, which makes budgeting easier. There's no guesswork. You know when the loan will be done as long as you make payments as scheduled. No collateral required. Most personal loans are unsecured, so you don't need to put up assets to get approved. Not having to pledge collateral means you aren't directly risking your house or car with the loan, though defaulting will still hurt your credit. This is a big plus compared to secured loans for those who don't have collateral or prefer not to use it. Lower interest rates for good credit. If you have solid credit, personal loan rates can be much lower than credit card rates. Many borrowers save money by using a personal loan to pay off high-interest cards. For perspective, in early 2025, the average personal loan rate was approximately 11.6%, while the average credit card rate was approximately 21.4%. That difference can mean significant interest savings when refinancing debt. Debt consolidation and credit building. Personal loans are a useful tool to consolidate multiple debts into one. This not only simplifies payments, but can improve your credit mix and potentially boost your credit score if you make on-time payments. Consistently paying a personal loan each month helps build a positive payment history, which is a big factor in your credit score. Fast funding and convenience. Personal loans often have quick approval and funding timelines. Many online lenders offer fast funding, sometimes even next-day funding after approval. The application process is usually easier than, say, a mortgage. You can often apply online and get a decision almost immediately. Fixed interest rate. The majority of personal loans have a fixed interest rate, so your rate and payment won't change over the life of the loan. This protects you from rate increases and provides stability. A few lenders have variable rate loans, but they're less common. Fixed rates give you certainty in planning your finances. Structured repayment discourages overspending. Unlike a credit card that lets you revolve and potentially keep borrowing, a personal loan structure forces discipline. You borrow a set amount and pay it back on schedule, which can prevent the cycle of just paying minimums and never getting out of debt. It's a forced plan to become debt-free by a certain date, which can be helpful if you need that structure. Requires good credit for best rates. To benefit from low rates, you typically need a strong credit score and reliable income. Borrowers with fair or poor credit may either be denied or offered high interest rates. Lenders also may not approve you if you have very limited credit history. Essentially, personal loans reward those with good credit. Others might find the cost quite high. Adds to your debt load. Taking on a personal loan means increasing your overall debt obligations. Your debt-to-income ratio will go up with a new loan. If you already have significant debt, another loan could strain your finances. It also could make it harder to qualify for other loans, like a mortgage, while the personal loan is still unpaid because lenders see you have a new monthly payment. No ongoing access to credit. Once you take a personal loan, that's it. You get one lump sum. There's no revolving feature or ability to draw more money without applying for a new loan. In contrast, a credit card or line of credit gives ongoing access if you need to borrow again. So if you miscalculate and need additional funds, you can't simply increase your personal loan. You'd have to apply for another loan. Potential fees and costs. Personal loans can come with fees. The most notable is an origination fee, which can be anywhere from 1% to even 10% of the loan amount, depending on the lender. Not all loans have this, but many online lenders do deduct a fee up front. There may also be late fees if you miss payments, and some loans have prepayment penalties, though those are relatively rare nowadays. Most let you pay off early without extra cost. It's important to read the fine print. Fees can increase the overall cost of the loan. Interest costs. While personal loans can have lower rates than credit cards, they are not always the cheapest option. If you have excellent credit, you might qualify for a 0% APR credit card promotion or a home equity loan with a lower rate than a personal loan. Also, even a loan at 10 to 15% APR means you'll be paying interest on the full balance until it's paid off. Depending on the term, you could still pay a significant amount in total interest. For borrowers with subpar credit, personal loan APRs can reach 30% or more, which is quite high. Always consider the total interest you will pay over the life of the loan. Higher monthly payments than credit cards. Because personal loans are on a fixed schedule, the required monthly payment might be higher than the minimum payment on a credit card of equivalent balance. For example, $5,000 on a personal loan might require a $150 per month payment to finish in 3 years, whereas a credit card minimum might be $125, but would take much longer to pay off. The higher payment could strain a tight budget, so you must be sure you can handle it. While it's good to pay debt off faster, you lose some flexibility. You must make that set payment every month. Credit consequences of default. If something goes wrong and you can't pay your personal loan, there's no collateral the lender can immediately take for unsecured loans, but your credit will suffer greatly. Missing payments on a personal loan will be reported to credit bureaus and can significantly drop your credit score. Defaulting on the loan could lead to collections or even legal action. Essentially, the stakes are high for your credit health. You can't just walk away from the debt without serious repercussions. With a secured loan, default also means losing the collateral. Temptation to borrow. Unnecessarily. With many lenders aggressively advertising easy personal loans, there's a risk that consumers might take loans for things they don't truly need, leading to overborrowing. It's important to remember that a loan is not free money. It's money you'll have to pay back with interest. Taking out loans for frivolous wants, like a luxury vacation beyond your means, can lead to a cycle of debt. Always have a clear and necessary purpose for borrowing. In summary, personal loans are a powerful financial tool. They offer a structured, lower interest way to borrow for those who qualify, but they also carry risks. Weighing these pros and cons in the context of your own financial situation is crucial. If the advantages align with your needs and you can manage the payments, a personal loan can be very beneficial. But if the downsides, like adding debt or high rates, outweigh the benefits, you might want to explore alternatives. Not all personal loans are created equal. Dozens of banks, credit unions, and online lenders offer personal loans, and the terms can vary widely. Interest rates, fees, loan amounts, and qualification criteria might be different from one lender to the next. To ensure you get the best loan for your needs, you'll want to be a savvy shopper. Here are the key steps and considerations when choosing a personal loan. Start by researching multiple lenders. It's wise to compare offers from at least a few sources. For example, check a national bank or two, a local credit union, and some online lenders. Each may have different benefits. When comparing, look at the following factors side by side. Interest rate, APR. The annual percentage rate is arguably the most important number, as it reflects the total cost of borrowing per year, including interest and certain fees. A lower APR means a cheaper loan overall. Even a difference of a few percentage points can save you a lot of money in interest. Some lenders might quote just an interest rate. Be sure to consider the APR, which accounts for fees like origination. Loan term. What repayment term options does the lender offer, e.g. 3 years, 5 years, etc.? And does the lender allow you to choose, or is it assigned? Pick a term that balances an affordable monthly payment with paying less interest over time. Many lenders give a range of term choices. Loan amounts. Check the lender's minimum and maximum loan amounts to see if your desired loan size fits. If you only need $2,000 but the lender's minimum is $5,000, that's not a good match. Conversely, if you need a large loan, say $50,000, make sure the lender can extend that much. Fees. Ask about origination fees, application fees, late fees, and any prepayment penalties. Some lenders charge an origination fee, deducted from your loan disbursement. while others don't. If there is an origination fee, factor that into the cost. Also, ensure there's no prepayment penalty. Most personal loans don't have one, but it's good to confirm you can pay early without a fee. Credit score requirements. Lenders often have a sense of what credit score range they're looking for. Some specialize in prime borrowers, high credit scores. Others will work with fair credit. It's useful to know if a lender is a realistic option for you before applying. Often you can find a lender's minimum credit score or typical credit range on their website or via inquiries. Secured versus unsecured. Check if the lender only offers unsecured loans or if they also have secured personal loan options, and whether you're open to that. If you have collateral and are having trouble qualifying unsecured, a secured loan might be an alternative. But remember the risks with collateral. APR range and rate type. Look at the range of APRs the lender offers, which gives you an idea if they cater to lower credit borrowers with high rates, etc., and whether the rate is fixed. The vast majority are fixed rate, which is preferable for stability. Funding time. If you need money fast, see how quickly the lender can approve and fund a loan. Online lenders often advertise funding within 1 or 2 days, while some banks may take longer. This might influence your decision if timing is critical. Customer service and reviews. Especially if you're working with an online-only lender, consider the customer support available. Is there a phone number to talk to a human if you have issues? Check reviews or ratings if possible. You want a lender known for fair, transparent practices and good service, since you'll be dealing with them through the life of the loan. Special features. Some lenders offer perks like a small interest rate discount if you set up autopay, or hardship forbearance programs, letting you pause payments if you hit a rough patch, or unemployment protection. These features can be nice bonuses, so note if any lender stands out with borrower-friendly policies. Total cost. Finally, compare the total cost of each loan offer. You can use a loan calculator to project how much interest you'd pay over the term for each and add any fees. Sometimes a lower rate with a longer term could end up costing more interest overall than a slightly higher rate with a shorter term. Make sure you're comparing apples to apples in terms of what you'll ultimately pay. By comparing these factors, you can identify which lender is offering you the most favorable deal. For example, lender A might have an 8% APR with a $200 origination fee, 3-year term, while lender B offers 9% APR, no origination fee, 5-year term. Depending on your priorities, lower monthly payment versus lower total interest, you might prefer one over the other. Don't hesitate to shop around. Checking rates with multiple lenders, especially via pre-qualification, will not hurt your credit score and can save you money. When choosing a loan, pay extra attention to the interest rate, fees, and term, as these define the financial impact of the loan. The interest rate, or more precisely the APR, determines your monthly interest cost and total interest paid. Even if everything else, loan amount term, is the same, a lower APR will mean lower monthly payments or a shorter payoff time for the same payment. Try to get the lowest APR you can qualify for. This may involve improving your credit, more on that shortly, or choosing a shorter term. Some lenders give lower rates for shorter loans. Fees can sometimes be overlooked but are important. A high origination fee can negate the benefit of a slightly lower interest rate. For instance, a 1 to 2% origination fee is common on many online loans. On a $10,000 loan, a 2% fee means $200. $200 is taken out as a fee. Some lenders might instead bake their costs into a higher rate but advertise no fees. Calculate which scenario is cheaper for you. Also, confirm there are no hidden fees. Most reputable lenders are transparent. Late fees are standard. You can avoid those by paying on time. But application fees or prepayment penalties are red flags nowadays. Loan term is critical too. A longer term lowers your monthly payment but increases total interest. A shorter term means higher payments, but you get out of debt faster. Consider your budget. You might opt for a middle ground term that keeps payments comfortable but doesn't drag out too long. A good strategy is to decide on the longest term you'd be comfortable with, for safety in case something tightens your budget, and then try to pay extra whenever possible to finish early. Since most loans have no penalty for early payoff, you can take, say, a 5-year loan, but plan to pay it in 3 years. This way, you have flexibility. The required payment is lower, 5-year basis, but you can accelerate when you have extra cash. But if you aren't disciplined, the longer term will just mean you pay more interest. The key is to find a balance: low rate, minimal fees, and a term length that suits your financial goals and cash flow. Use pre-qualification results or loan calculators to simulate different scenarios. Before you even apply formally, it's highly advisable to check your own credit and, if possible, pre-qualify with a few lenders. Start by pulling your credit reports. You can get them free from annualcreditreport.com and knowing your credit score. Make sure there are no errors on your report that could unfairly drag down your score. If you find any, dispute them before applying for loans. Knowing your score will also guide you toward lenders that are likely to approve you. For instance, if your FICO score is 720, you'll be an attractive borrower to most lenders. If it's 620, you might focus on lenders who cater to fair credit. Pre-qualification is a process where you provide some basic info, often just estimated credit score, income, desired loan amount, and the lender performs a soft credit check to give you a tentative rate quote. This does not hurt your credit score. Pre-qualification is extremely useful because it lets you compare potential rates and terms from multiple lenders without any commitment. Many online platforms and banks offer pre-qualification online with instant results. You might get something like, Lender X pre-qualifies you for up to $10,000 at 11% APR for 3 years, and Lender Y pre-qualifies you at 9% APR for 3 years, 5 years, etc. While these are not guaranteed offers, they're usually pretty accurate as long as the information you provided is correct. When you see these quotes, you can then decide which one, if any, you want to formally apply for. Another reason to pre-qualify is to see if there are any issues that come up. If you pre-qualify nowhere or get only very high rate estimates, that's a sign you might need to improve your credit or DTI before applying. It's better to find that out before submitting full applications, which do put a hard inquiry on your credit. Once you've compared and found a likely best option, you can proceed with that lender's full application. Some additional tips for choosing wisely. Consider your existing bank or credit union. If you already have a relationship, check if they offer personal loans with loyalty discounts or easier approval. Sometimes being a customer can help. Also, read reviews or ask friends/family if they've used a particular lender. A smooth application and good customer service can make the borrowing experience much better. Lastly, beware of very high interest loans or scams. If your credit is poor, you might encounter offers from predatory lenders with extremely high rates or unreasonable terms. It may be better to wait and improve your credit rather than take a 60% APR loan, for example, which some payday-adjacent installment loans might carry. Always ensure the lender is reputable. Legitimate personal loan lenders will be clear about rates and terms up front and will check your ability to repay. If someone is pushing a loan without checking credit or income but at sky-high cost, that's a red flag. In summary, to choose the right personal loan, do your homework, check your credit, shop around through pre-qualifications, compare all important factors, APR, term, fees, etc., and pick the offer that best fits your needs and budget. A little extra effort in the comparison stage can save you a lot of money and headaches over the life of the loan. Taking on a personal loan is a significant financial responsibility. While personal loans can be extremely helpful, it's critical to manage them wisely so that they improve your financial situation rather than hurt it. Here are some tips for responsible borrowing when it comes to personal loans. Before you borrow, have a repayment plan. This means creating or adjusting your monthly budget to incorporate the new loan payment. Look at your current income and expenses and determine what payment amount you can comfortably handle each month without falling behind on other obligations. It can be tempting to take a larger loan or longer term just because you qualify, but remember you'll be paying it back every month. A good rule of thumb is to keep your total debt payments, including the new loan, within a reasonable portion of your income. This ties back to the debt-to-income ratio we discussed. If adding a personal loan would leave you scraping by each month or relying on credit cards to cover essentials, that's a warning sign you might be overextending. Once you have the loan, treat the payment like a non-negotiable bill. Make sure your budgeting accounts for it, just like rent or mortgage, utilities, etc. Perhaps you cut some discretionary spending to free up cash for the loan payment. It can help to automate the payment so that on a set date each month, the money is withdrawn. This way you won't accidentally miss it. However, ensure you have enough balance in your bank account to avoid overdrafts. If you fear you might have trouble one month, communicate proactively with your lender. Some have hardship options or may allow a 1-month deferment in certain cases, though interest still accrues. But ideally, you've planned for the payments. It's also smart to build an emergency fund even while repaying the loan, if possible, so that an unexpected expense doesn't derail your loan payments. Avoid borrowing more than necessary. Only take the amount you actually need for your goal. It might be tempting if you're approved for more. I got approved for $15,000 but only need $10,000. Maybe I'll take $12,000 just in case. Remember, every extra dollar you borrow is a dollar plus interest you have to pay back. Stay focused on the purpose of the loan and borrow the minimum to accomplish it. This keeps your payments lower and payoff time shorter. In essence, live within your means even with the loan. Use the loan to solve a financial issue or achieve a goal, not to enable continued overspending. If the loan is for debt consolidation, be vigilant not to rack up new debt again. Stick to a budget that allows you to pay all your bills, including the loan, and still save a little if you can. Responsible borrowing is as much about planning and budgeting as it is about signing the loan papers. Loan stacking is a term for taking out multiple loans in a short period of time, and it's generally a dangerous practice to avoid. It might be tempting if you have several needs, or if one loan didn't cover everything. For example, someone takes a $5,000 personal loan, then a month later applies for another $5,000 loan from a different lender, and so on. The problem is you can end up with overlapping debt that quickly becomes unmanageable. Each loan comes with its own interest and monthly payment, and stacking them can lead to a situation where your income can't comfortably cover all the payments. Borrowers who stack loans often find themselves in a debt spiral, essentially using new loans to fill gaps left by old loans. Many lenders will check your credit and see recent loan inquiries or new accounts, which can make approval for additional loans harder for good reason. It signals you might be overextending. But some high-cost lenders might approve you regardless, leading to a worst-case scenario of owing multiple lenders at once. Avoid loan stacking by planning ahead and borrowing a sufficient amount the first time if you decide a personal loan is needed, rather than taking several smaller loans back to back. If you find that one loan wasn't enough, it may be better to talk to your existing lender about possibly refinancing for a larger amount if they offer, rather than opening a new loan elsewhere, or find an alternative solution. If you currently have more than one personal loan, prioritize getting them under control. Perhaps focus on paying one off faster, maybe the smaller balance or higher interest loan, before considering any new borrowing. Some people consolidate multiple personal loans into one if they can qualify for a larger loan at a good rate to pay off the others, effectively unstacking them into a single payment. But this only works if you also change the behavior that led to taking multiple loans. In short, be very cautious about taking on multiple loans simultaneously. Each loan adds to your debt load, and juggling several can overwhelm even a solid budget. It's usually better to solve your financial needs with one well-planned loan, or none if possible, rather than a patchwork of many loans. Not all loans are created equal, and unfortunately, there are some lenders and loan products out there that are downright predatory. Chief among these to avoid are payday loans and similar ultra-high-interest short-term loans. Payday loans are those quick cash loans, often for a few $100s, that are due in full on your next payday, and they carry shockingly high fees and interest rates, often equivalent to 300% to 400% plus APR. These loans are considered a form of predatory lending because they trap borrowers in cycles of debt. Many people can't pay the full amount back in 2 weeks and end up renewing or taking another payday loan, incurring more fees each time. In fact, payday loans are so harmful that they are outlawed or heavily restricted in many states. As a rule, steer clear of payday lenders or any loan that advertises no credit check, cash today, with extremely high fees. The same goes for car title loans, loans secured by your vehicle title, often at high rates, and certain online installment loans aimed at poor credit borrowers that have exorbitant APRs. These are considered predatory because they prey on people in desperate situations and can make their financial situation worse. If you ever feel you have no option but a payday loan, it's worth exploring alternatives. Perhaps a small loan from a credit union, many offer payday, alternative loans at much lower cost, borrowing from a friend/family, or even negotiating with creditors. Some nonprofits and community organizations also offer emergency microloans or financial assistance. When considering any lender, do a bit of homework. Check their rates and terms. If you see an APR in the triple digits or large upfront fees that seem disproportionate, run the other way. Reputable personal loan lenders, banks, credit unions, established online lenders will offer rates generally between 5% and 36% APR, depending on credit, and they structure loans with monthly payments over a reasonable period, at least 12 months, often longer. Predatory loans, in contrast, might demand full repayment in a short time or charge interest so high that almost none of your payment goes to principal. Another tip: be wary of scam loan offers too. If someone guarantees approval without even checking your credit or asks for an upfront payment, like a processing fee paid via gift card or wire transfer, before giving you the loan, those are scams. Legitimate lenders charge fees out of the loan proceeds, not as a separate upfront payment, and they never guarantee a loan without due diligence. In summary, stick with trusted, licensed lenders. If a loan's terms sound too good to be true or the opposite, abusively expensive, just don't take it. There is almost always a better way than a payday or predatory loan. Responsible borrowing means not only managing the loans you do take, but also knowing which loans to avoid entirely. A few additional tips to be a responsible borrower. Read the fine print of your loan agreement. Understand your interest rate. Is it fixed or variable? Your payment schedule, all fees, and any special clauses. Knowing your rights and obligations will prevent surprises later. Keep your lender informed if you run into trouble. If you lose your job or have a financial crisis that jeopardizes your ability to pay, some lenders have hardship programs or can work with you on a plan. Ignoring the issue will only lead to defaults and collections, so communicate early. Avoid using personal loans to cover everyday expenses because of overspending. If you find yourself considering a loan just to cover monthly bills or credit card payments, it's a sign to seek financial counseling or adjust your budget. Personal loans should ideally be used for one-off needs or consolidating, not as a band-aid for chronic budget shortfalls. After the loan, focus on rebuilding savings. Once you're in repayment mode, try to also set aside a little each month if you can for an emergency fund. This way, you won't need to immediately turn to another loan if an unexpected expense comes up. Don't hesitate to ask questions. If something in the loan process or terms is unclear, ask the lender. It's their job to help you understand. Responsible borrowers are informed borrowers. By following these principles, budgeting properly, not overborrowing or stacking loans, and steering clear of predatory traps, you can use personal loans to your advantage without derailing your financial health. The goal is for the loan to solve a problem or improve your situation, and then pay it off in a timely manner. Wrapping up, a personal loan can be a useful financial tool for many situations. It provides a lump sum of money that you pay back in structured, predictable installments. We've covered the basics of what personal loans are and how they work, including how they differ from credit cards and auto loans, the typical application process, and what lenders look for. You've learned about common uses like consolidating debt, covering emergencies, making home improvements, or paying for major life events, as well as the pros and cons that come with borrowing. Remember, the advantages, like flexibility, fixed payments, and potentially lower rates, need to be weighed against the costs, interest, fees, and the commitment of monthly payments. We also discussed how to shop around and choose the right loan by comparing rates, terms, and fees from different lenders, and emphasized the importance of responsible borrowing. Always budget for your payments, avoid taking on too many loans at once, and stay away from predatory lenders. If you're considering a personal loan, take a moment to assess your own finances and needs. Ask yourself, does a personal loan make sense for my situation? Can I comfortably afford the monthly payment? Have I explored all alternatives? If you decide to proceed, be sure to compare offers from trusted sources. It's worth checking out rates from reputable banks, credit unions, or online lending platforms. We've put together some resources and recommendations in the description to help you find trusted personal loan offers that have competitive rates. Feel free to check those out if you're ready to explore your options. Finally, thank you for watching and staying with us through this full beginner's guide on personal loans. We hope you found this information helpful and empowering. If you enjoyed the video or learned something new, please give it a thumbs up and consider subscribing to our channel. We regularly post content on personal finance and borrowing tips, so by subscribing, you won't miss our next helpful guide. And speaking of that, be sure to stick around for the next video where we'll dive into another important topic. You can click on it right here on the end screen. Good luck with your financial journey, borrow wisely, and until next time, take care.